If you follow Zimbabwean news with any regularity, you have probably heard of the name Mutapa Investment Fund mentioned again and again. It appears in speeches, in budget statements, in press briefings, in policy announcements. It's spoken about with seriousness, usually reserved for something very important. Yet, if you stop the average person on the street and ask them to explain what it is, what it does, why it matters, chances are you would be met with hesitation. Hello and welcome to Fate of the Nation with me, Unique Zimbabwe. And today we'll be asking the questions: what on earth is the Mutapa Investment Fund? The phrase most often attached to it is the sovereign wealth fund. That sounds technical, doesn't it? It sounds global. It sounds like something that belongs in Oslo or Doha, not Harare. And unless you already have some working understanding of finance or public policy, the explanations offered by regulators and officials can feel abstract and distant from everyday life. So let's strip down to the basics. What is the sovereign wealth fund? Why do countries create them? What type is Zimbabwe's investment fund? What does it actually own? How does it make money? And perhaps most importantly, what should taxpayers realistically expect from it, both in theory and in practice? Let us begin at the beginning. A sovereign wealth fund is, at its simplest, a state owned investment bank. Think of it as a national investment company owned by the country. Instead of an individual saving money, buying shares or property, the state pools assets and invests them with the aim of growing wealth over time. It's important to understand what a sovereign wealth fund is not. It is not the annual national budget. It is not a ministry. It is not simply a bank account where tax money is kept before being spent on salaries and roads. A sovereign wealth fund is designed to hold assets and invest them so that they generate returns over the long term. Countries usually create a sovereign wealth fund for one or two broad reasons. The first is because they have large natural resource revenues, such as oil, gas, or minerals. Rather than spending all that money immediately, they save and invest some of it for the future. The second reason is to manage and professionalize state assets, particularly state owned companies, so that they become commercially viable and less dependent on government bailouts. Globally, sovereign wealth funds come in different shapes and sizes. Some are what we call stabilization funds. These act as rainy day funds, as backup when things go horribly wrong. For example, when commodity prices fall or when the economy faces a shock, the government can draw from the fund to stabilize spending. Others are savings fund, so sometimes called future generations funds. These are designed to convert finite natural resources into long-term financial assets. The idea is simple. Oil runs out, minerals are deposited. But if the profits from these resources are invested wisely, future generations can still benefit long after the resources are gone. There are also pension funds. These are set aside to help governments meet future pension obligations as populations get older. And then there are strategic investment or development funds. These are not only about saving, they are about actively managing and restructuring state assets so that they become productive and profitable contributors to the economy. The last category is where Zimbabwe's investment fund largely sits. Zimbabwe first legislated a sovereign wealth fund in 2014. The original idea was to create a vehicle that could capture value from mineral revenues and invest in its natural development. However, for several years, the fund existed more on paper than in practice. It did not operate at the scale or visibility that one would associate with major sovereign wealth funds elsewhere. In 2023, the fund was restructured and rebranded as the Mutapa Investment Fund. Its mandate was broadened and clarified. Rather than focusing narrowly on future mineral revenues, it became a holding and investment company for a wide range of state owned enterprises and strategic assets. The shift is crucial to understanding what Mutapa is today. It is not merely a pot waiting for mining royalties to accumulate. It is effectively the government's central holding company for many of Zimbabwe's most significant public enterprises like ZESA, Tel1, the national railways, mines like Kuvimba, and many others. To understand what that means, imagine the government deciding to gather its major commercial assets under one roof. Instead of each state owned enterprise reporting separately through different ministries, they are transferred into a single investment vehicle. That vehicle is then tasked with improving its performing, strengthening governance, attracting capital, and ideally generating returns. That vehicle is the Mutapa Investment Fund. So, what does it own? The portfolio is extensive and spans multiple sectors of the economy. It includes mining interests, energy utilities, transport companies, telecommunication operators, financial institutions, and agriculture enterprises. In mining entities associated with gold, platinum, and lithium production, it falls within the broader ecosystem linked to the fund. In energy, power generation and electricity transmission companies have been placed under its oversight. In transport, rail and public bus services are included. In telecommunications, state owned operators are part of the portfolio. Banking services and agricultural processing companies also feature. Taken together, these entities represent a significant portion of Zimbabwe's formal economic infrastructure. They are not small side projects. They are companies that supply electricity, move people and goods, provide communication networks, process agriculture output, and extract mineral wealth. Many of these enterprises have historically faced challenges. Some have struggled with underinvestment, aging equipment, debt burdens, governance weaknesses, and inconsistent profitability. In several cases, they have required periodic government support to continue operating. The logic behind placing them under a sovereign wealth fund is that a centralized, commercially oriented holding company can impose stronger performance discipline. Instead of ministries focusing on primarily on policy oversight, the fund focuses on shareholder value. Instead of state owned enterprises operating in isolation, they become part of a coordinated investment strategy. In theory, this allows for better capital Allocation. Profitable entities can support restructuring in weaker ones. Assets can be partially privatized or listed to unlock value. Strategic investors can be brought in without necessarily relinquishing full state control. But this brings us to the question that most people care about. Does the Mutapa Investment Fund actually make money? Well, there are several mechanisms. The first is dividends. If a company in the portfolio becomes profitable, it can declare dividends to its shareholder. In this case, the shareholder is the Mutapa Investment Fund. Those dividends then become income for the fund. The fund can reinvest that income or, depending on policy decisions, remit some of it to the Treasury. The second mechanism is capital appreciation. If the value of a portfolio company increases over time, the net asset value of the fund rises. This may not immediately translate into cash, but it represents an increase in national wealth on paper. The third mechanism is partial disposals or listings. If a company has had turned around and is performing well, the fund may decide to sell a minority stake to private investors or list a portion of the company on stock exchange. If that sale occurs at a higher valuation than the original book value, the fund realizes a gain. The fourth mechanism involves strategic partnerships. By attracting external investors into specific projects, the fund can leverage additional capital without relying solely on the national budget. All of this sounds logical, right? But it depends on one crucial condition. The underlying companies must either become profitable or at least increase in value. If portfolio companies continue to generate losses, require subsidies, and accumulate debt, then the fund's ability to generate returns is severely constrained. This leads to the broader issue of governance. A sovereign wealth fund by design sits at the intersection of politics and commerce. It is owned by the state, yet it must operate with commercial discipline. It is accountable to the public, yet it must compete in the markets. This tension is not unique to Zimbabwe. It is a structural feature of all sovereign wealth funds. Globally, successful funds tend to share certain characteristics. They have clear legal mandates. They publish regular, detailed financial reports. They maintain professional management teams with investment expertise. They separate political decision making from day to day commercial operations. Where these conditions are weak, sovereign wealth funds can struggle. They become vehicles for political objectives that override commercial logic. They may lack transparency, making it difficult for citizens to assess its performance. They may accumulate assets without generating meaningful returns. So, what should Zimbabwean taxpayers expect from the Mutapa Investment Fund? In theory, the potential benefits are significant. If the fund successfully restructures state owned enterprises, improves efficiency, and strengthens profitability, several positive outcomes could follow. First, the budget or national budget could decrease. Instead of bailing out loss making companies, the Treasury could receive dividends. Second, the overall value of national assets could increase. This strengthens the country's balance sheet and potentially improves its attractiveness to investors. Third, Improved performance in key sectors such as energy and transport can have wider economic benefits. Reliable electricity and efficient logistics support private sector growth, which in turn broadens the tech space. Fourth, if parts of the portfolio are listed or open to public participation, ordinary citizens may gain more opportunities to invest directly into national assets. That is, of course, the theoretical promise. In practice, the picture is more complex. The Mutapa Investment Fund is still relatively young and The Mutapa Investment Fund is still relatively young in its current form. Turning around large enterprises is not a quick exercise. It often requires debt restructuring, capital injections, management changes, and sometimes difficult decisions about workforce rationalization and asset sales. Moreover, transparency and public communication are essential if citizens are to understand whether the fund is delivering on its mandate. Without regular, accessible reporting on financial performance, asset valuations, and strategic decisions, public debate can become speculative and polarized. Another practical consideration is time horizon. Sovereign wealth funds are typically long term vehicles. Returns may not be visible within a year or two. They may require a decade or more to demonstrate meaningful transformation. This raises an important question. Does Zimbabwe actually need a sovereign wealth fund? The answer depends on how you frame the problem. Zimbabwe has significant natural resources and a portfolio of strategic state assets. Historically, however, the management of these assets has been fragmented, reactive, and often driven by short term fiscal pressures rather than long term investment logic. For many years, state owned enterprises operated under like for many years, state owned enterprises operated under line ministries whose primary focus was policy and regulation, not portfolio optimization. When companies struggled, the solution was frequently a treasury intervention. When they performed well, surplus was not always reinvested strategically. Result was a cycle in which public enterprises were essential to the economy, yet seldom positioned as engines of compounding national wealth. A sovereign wealth fund, at least in theory, attempts to correct the pattern. By consolidating ownership under a single investment authority, the state signals that these enterprises are not merely extensions of bureaucratic departments, their assets are the balance sheet. They carry value. They require also oversight, performance measurement, and strategic direction. They must justify capital allocation decisions in the same way a private holding company would. For citizens, understanding the mechanics of a sovereign wealth fund transforms the conversation. Instead of reacting to announcements, it becomes possible to evaluate performance against clear principles. Are assets increasing in value? Are companies moving toward profitability? Is reporting consistent and credible? Are partnerships structured to enhance long term capacity rather than merely to plug to short term gaps? In the end, the question is not simply whether Zimbabwe needs a sovereign wealth fund. The question is whether Zimbabwe can build one that is transparent, commercially disciplined, and genuinely wealth creating for present and future generations. That is the challenge, and that is the opportunity. Thank you for joining me on The Fate of the Nation. I'm Unique Zimator, and we'll see you next time.